We are taught that your money in the bank is safe, that governments protect deposits, that banking rules exist to prevent confiscation. But this is the version they tell you to keep your money in the system. The truth is that in March 2013, on a single weekend, Cyprus destroyed the most fundamental rule of banking. And what they did in Cyprus became the blueprint for every major economy in the world. This is the story of the weekend that made your bank account a liability. To understand what happened in Cyprus, you need to understand what banking was before March 2013. Since the Great Depression, Western democracies followed one sacred rule. When banks fail, governments bail them out, taxpayers pay, depositors are protected. This was the social contract. The FDIC in America insures deposits up to $250,000. The FSCS in Britain insures up to £85,000. Every developed nation had some version of this protection. But there was a problem. After 2008, governments had spent trillions bailing out banks. The United States spent $700 billion through TARP. Britain spent $137 billion. Ireland spent $64 billion. By 2012, sovereign debt was exploding. Politicians faced a choice: bail out more banks and collapse government finances, or find a new way to handle banking crises. Cyprus gave them the answer. Cyprus in 2012 was a banking paradise. The island nation of 1 million people hosted banks holding €126 billion in deposits, 7 times the country's entire GDP. Russian oligarchs loved Cyprus. Low taxes, EU membership, and most importantly, banking secrecy. But Cyprus banks had made a catastrophic bet. They were loaded with Greek government bonds. When Greece restructured its debt in 2012, those bonds became worthless. The two largest Cypriot banks, Bank of Cyprus and Laiki Bank, were insolvent. They needed €17 billion to survive. Cyprus turned to the European Union and the IMF for a bailout. On March 15, 2013, European finance ministers met in Brussels. The meeting lasted through the night. At 4 a.m. they announced the deal, but this was not a bailout. This was something the world had never seen. The Troika, the European Central Bank, the European Commission, and the IMF demanded that Cyprus raise €5.8 billion, not from taxpayers but from depositors. Every bank account in Cyprus above €100,000 would be taxed. The rate was 9.9%. But here was the shocking part. Accounts below €100,000, the protected deposits, would also be seized. 6.75%. The announcement came on a Saturday morning. Banks were closed, ATMs were shut down, no one could withdraw their money. Cypriots woke up to discover that the government had taken their savings while they slept. The reaction was immediate. Thousands stormed the streets, they tried to break into banks, they demanded their money back, but there was nothing they could do. The money was already gone. The Cypriot parliament met on March 19. They voted on the confiscation plan. The result was 36 votes against, 19 abstentions, 0 votes in favor. Even the politicians who designed the plan refused to vote for it, but the damage was done. The precedent was set. On March 25, a revised plan was announced. Accounts below €100,000 were protected, but accounts above that threshold were devastated. At Bank of Cyprus, 47.5% of all deposits above €100,000 were converted to worthless bank stock. At Laiki Bank, all deposits above €100,000 were completely wiped out, 100% loss. In total, €5.8 billion were seized from depositors. The international banking community watched in horror. For the first time since the Great Depression, a developed Western democracy had confiscated bank deposits. But European officials were not apologetic. Jeroen Dijsselbloem, the head of the Eurogroup, gave an interview to Reuters. He said this, quote, "If there is a risk in a banking system, the first ones to take the hit are shareholders, then bondholders, and then depositors," end quote. This was the new rule. Bail-in, not bailout. And Cyprus was just the beginning. Within months, the mechanism was formalized. The European Union passed the Bank Recovery and Resolution Directive in 2014. It made bail-ins the official policy across all 27 EU member states. The law was explicit. When banks fail, depositors above €100,000 are now creditors. Their money can be seized to recapitalize the bank. Britain passed its own version in 2015. The Banking Act gave the Bank of England powers to impose bail-ins on any failing bank. Canada passed bail-in legislation in 2016 under the Economic Action Plan. The law allows the government to convert bank deposits into bank equity during a crisis. The United States embedded bail-in language in the Dodd-Frank Act through the Orderly Liquidation Authority. The FDIC can now seize deposits above the insurance limit during systemic crises. Australia, New Zealand, Switzerland, Japan. Every major economy adopted some version of the Cyprus model. By 2016, the Bank for International Settlements, the central bank of central banks, published a report. It stated that bail-ins were now the global standard for bank resolution. The weekend in Cyprus had rewritten the rules for the entire planet. But here is what they do not tell you. The mechanism only works if people cannot withdraw their money. In Cyprus, the government imposed capital controls. For over 2 years, Cypriots could not move more than a few €100 per day. Wire transfers abroad were blocked. Tourists could not use their credit cards. Businesses could not pay suppliers. The economy collapsed. Youth unemployment hit 50%. GDP fell 26% in 3 years, but the banks survived. And that was the only thing that mattered to Brussels. The lesson was clear. When the next crisis comes, your money is trapped. You cannot withdraw it. You cannot move it. You can only watch as it is seized, and the next crisis is already here. In 2023, 3 American banks collapsed in 1 week. Silicon Valley Bank, Signature Bank, First Republic Bank, combined assets of over $500 billion. The FDIC stepped in with emergency measures. Uninsured deposits were protected, but only because it was politically necessary. In Switzerland, Credit Suisse collapsed in March 2023. The Swiss government forced a merger with UBS. Bondholders were wiped out, but depositors were protected for now. The question is not if bail-ins will be used again. The question is when. In 2024, the IMF published a working paper titled Bail-ins and Bank Resolution. It concluded that bail-ins are the most efficient tool for managing systemic banking crises. The European Central Bank has been running stress tests on how to implement bail-ins during the next crisis. The results are classified. In Canada, leaked government documents from 2024 revealed contingency plans for deposit seizures if the housing market collapses. In the United States, the FDIC has been quietly updating its orderly liquidation authority protocols. The updates allow for faster implementation of bail-ins with less judicial oversight. Every piece is in place: the laws, the mechanisms, the justifications. All they need is the crisis. And when it comes, it will happen the same way it happened in Cyprus. On a weekend while the banks are closed. Before you can react, you will wake up on Monday morning to discover that your account balance has changed. Not because you spent the money, but because the government decided you are now a creditor. Your savings are not savings anymore, they are a loan to a failing bank. And when that bank collapses, your loan is worthless. This is not a conspiracy theory. This is official policy. Written into law, approved by parliaments, endorsed by central banks. The weekend in Cyprus destroyed the idea that your money in the bank is yours. It established a new truth. Your deposits are not protected. They are the first line of defense when banks fail, and every government in the world has agreed to this system. The question you need to ask yourself is simple. When the next crisis comes, and your government announces capital controls, and your bank account becomes a bail-in target, where will your money be? In 2013, Cypriots learned the answer too late. In 2026, the same mechanism is waiting for you. The weekend that seized €5.8 billion was not an anomaly. It was a rehearsal.